I know early into this piece, when we just were at the sort of cusp of these lockdowns and the work from home scenarios that you included or finding yourself in now, you were talking about the need for massive fiscal responses. Now, you said unimaginable amounts, maybe 20% of GDP or more. Now, that's not quite the extent that we've seen clearly in Australia, but that $2.3 trillion package coming out from the Fed last week. I mean, is that the kind of do all, take no prisoners response that you had been expecting, or, are you still expecting more?
Well, the US, if you take the monetary and the fiscal stimulus and you kind of normalize it and add it together, it's about 40% of GDP. It's so large, it makes your brain hurt to think about their size. To give you an idea, so if you're a small company in the US, less than 500 people, the government is now going to pay your wages, rent, and utilities for 2 months. So you don't have any outgoings for 2 months. Now, that's going to be fine if the duration of the coronavirus is quite short. If we drag this out for 3, 6, 12 months from now, well, then that's not going to be enough. And that's the problem. What the central banks and what the fiscal authority is doing is they're providing liquidity into the system, but we're not solving the solvency issue at all. You're still going to have so many companies going bankrupt over the next few quarters.
Absolutely. What is your gut telling you, Vimal? I'm not saying that's how you make your investment decisions. Do you think that the worst of this is over, not necessarily in the economic data? And just as a side note to that, we have had this unemployment read coming through here in Australia, the March unemployment rate at 5.2%. So that's actually, it's not going to say great, but it's better than the consensus of 5.4%. I haven't delved any deeper into those figures, but when it comes to let's talk about economies opening up potentially. I mean, what are you feeling about where we're at in this timeline?
The US numbers are expected to go from about 5 to about 20. Yeah, so the April numbers are going to be roughly about 20% unemployed in the US. So, like small, when we're talking 5.2, 5.5, they're rounding errors. I mean, it's completely irrelevant in the broadest trend of where things are going. Mm-hmm. In terms of when we can reopen, I mean, obviously there's a big clamour to reopen, and Trump talked about the cure being worse than the disease, and that's true on an economic viewpoint. And right now we are purely looking at the lockdowns in terms of what it means for the population, but in terms of deaths from the virus. But there are also deaths that will happen if we lock down the economy. There's poverty. You look at India, which is in a full lockdown. It's just been extended again. The amount of people in poverty there who are at risk of dying because they're unable to get food. So there are economic impacts as well. And I think at the moment we're purely looking at the medical side. We're not looking at the economic side. And there needs to be a full realization of how bad the lockdown is for people and the communities, and also health levels. So I think that there's both sides of the argument that needs to be looked at this, but I don't see a quick reopening. And also, from the reading I'm doing, we're 12 to 18 months away from a vaccine. And so we're going to be living with this for a long time. And as I mentioned, the solvency issues haven't been dealt with. They've just been pushed further into the future. So I think this is going to be with us for a long time yet.
And so given all of that, where to for global bond yields now, do you think?
Oh, that's the easy one. That's the easiest call you could do. They're going to zero. Global bonds, apart from maybe Italy or Spain or Portugal or some of the smaller peripherals, pretty much global bonds around the world are going to zero. Central banks need them at zero. We have to also accept and acknowledge the fact that bond yields going down doesn't really help. It doesn't really cushion the impact of the virus and the economic data, but it doesn't do any harm. And that's really where we are now. It's about doing anything that doesn't do harm to help the economies along, and pushing bond yields down to zero and supporting them at those levels as we're doing mass issuance across the world is the only thing they can do. They can't allow bond yields to sell off because that would have a slowing impact in the economy. I mean, one of the issues for the US is if your currency is weak, your currency is strengthening and your equity market's going down, and then you get bond yields selling off, well, then all three parts of your financial conditions are tightening, and that's really bad. So they need to hold bond yields down, and they will hold bond yields down. And we're seeing that, RBNZ talking about negative rates, RBA in any size at 25 basis points in 3 years, the size of the programs we're seeing in the US. I mean, to give you an idea, in the last QE program in the US, they were buying about 80 billion a month. They were buying 75 billion a day just last week. I mean, the size of the packages are so large, and they have one aim, and that's to get bond yields to zero across the world.